Hi everyone, my name is Bob Olson, and I'm the founder and president of the Robert Olson Wealth Group, a family wealth advisory firm that specializes in guiding clients through the dangers and complexities of today's financial world. We work primarily with the families of affluent older couples that are approaching or enjoying their retirement years. That means couples that are age 50 to age 70. We also work with a smaller group of successful younger families and single individuals as well. The vast majority of our clients are busy and active in a wide variety of areas and value the opportunity to delegate a large number of financial tasks to a trusted firm of wealth professionals. This doesn't mean that they give up any individual or personal control. It simply means that they're willing to assign the implementation of their financial goals to experts that specialize in taxes, investments, estate planning, and retirement-related money issues. I've been a practicing CPA for more than 35 years now. I'm also a certified financial planner, a registered investment advisor, and hold a number of other licenses and designations that all relate to our primary areas of practice, which are taxation. We implement strategies that minimize or eliminate income tax for our clients, especially in their retirement years. Most experts agree that because of the current level of excessive government spending and the demographic trends that are currently in place right now, taxes will most likely be increasing dramatically in the future. So this component of what we do for our clients is becoming more and more important. Investments. We manage, monitor, and optimize our clients' investment funds using proprietary investment models and methodologies so that our clients can rest easy knowing that their basic retirement income will never run out. They also benefit by being able to maximize their investment returns in good financial market conditions while minimizing losses, risk, and volatility in bad market conditions. Estate planning. We craft and implement custom-designed estate plans for each of our clients. With a written estate plan in place, everyone has a much higher chance of success when it comes to passing on their financial legacy with a minimum of time, cost, and heartache. Retirement strategies. We help our clients maximize their Social Security retirement benefits, which is the foundation for all retirement income plans. We then allocate and rebalance our clients' financial assets so that a series of income sources are created that will provide our clients with monthly income that they will never run out of. In short, we assist our clients to build and preserve their family's wealth so they can live their lives with dignity and without financial worry. So how do we accomplish all of this? Well, we accomplish these objectives through a series of unique concepts and frameworks that we've developed over the years. The presentation that I'm about to share with you deals with the investment piece of a family's wealth picture. This video discusses one specific investment model that we often blend with other investment models in order to achieve the financial results that our clients are seeking. I've created a series of additional presentations on all of the specific models and methodologies that we're currently using. Please feel free to browse through the video pages of our website for these other presentations. One final note before we get started. This presentation is primarily educational in nature. It is designed and crafted for our existing clients who are seeking some additional information or a refresher on how we invest client funds. And it's also designed for our prospective clients that would like to gather some additional information on our investment philosophy and unique methodologies. There's no sales pitch, there's nothing to buy, and no need for you to pull out your credit card. So rest easy and just sit back, listen, and enjoy the presentation. Let's get right to work. I call this the sector rotation model for two reasons. Firstly, it uses investment components from 11 broad sectors of the U.S. economy, and secondly, we periodically rotate in and out of the top 4 performing market sectors, thus sector rotation. I know what you're thinking. Here we go again, another investment model. Well, you know what? You're exactly right. I am constantly fine-tuning our existing models and creating new ones that fit specific clients or investment situations. Today, we live in a world that is constantly changing and changing more rapidly than ever before. Technology is improving by leaps and bounds. Financial markets are now interconnected with a mouse click, and clients are demanding more customized solutions for their unique situations. Our fact-based money management philosophy is all about current supply and demand in the financial marketplace. So I've simply taken that philosophy one step further. When I visit with clients throughout the year, they seem to be a very demanding group, which helps keep my team and me on our toes. One of the topics of discussion that seems to have been brought up more often than usual recently has been the interest in a new investment model that is a little more aggressive, with a potentially higher rate of return. Now, many of our current clients have green money investment strategies in place that are designed to preserve and protect a portion of their financial assets from loss and that will provide them with guaranteed income for the rest of their lives. So, the remaining portion of their investment portfolio can be managed in a more aggressive fashion. With that scenario in mind, I've developed what I call the sector rotation model that continues to use broad index exchange-traded funds, or ETFs, which have an extremely low cost of ownership. And I've tried to develop this new model to take advantage of conditions that reward low trading frequency as well. The difference with this new model is the type of ETF used and the selection criteria used for determining when to use equities and when to move to bonds. In the new model, we don't use ETFs that are distinguished by market capitalization, such as small cap, mid cap, and large cap. Instead, we use ETFs that reflect broad sectors of the economy, and we use a slightly different selection criteria than our older models. Here is how the sector rotation model works. The first question we always ask ourselves is this: should we be in equities or in bonds? In other words, are the financial markets in a bullish condition or in a bearish condition? We ask this first question on a quarterly basis on the first day of every calendar quarter, based on fact-based quantitative criteria such as momentum, relative strength, rate of change, nearest to 52-week highs, and other measurements of performance, if either domestic or international equity markets are up, then the top performing equity sectors are used for the quarter. If neither the domestic nor the international equity markets are up, then we exit the markets and use a series of bond sector investments. So, at the beginning of each quarter, if equities are in an uptrending condition, then we select the top 4 sector ETFs and then rebalance those top 4 on a monthly basis during the following quarter. We use equal percentages of the top 4. That means 25% each. The 11 broad sectors of the U.S. economy are shown here. Sectors periodically move into and out of the top 4 slots, but experience and backtesting have shown that once a sector moves into one of the top 4 slots, it tends to persist, which means that over a quarter or yearly period of time, there is a slight movement into and out of the top 4, but not frequent movement. As we can see, on August 13th, 2015, for instance, the top 4 sectors were consumer cyclical, healthcare, consumer non-cyclical, and financial. When the domestic and international financial markets are trending downward, we rebalance using equal allocations of the top 3 ranked bond investments. In this particular case, a PIMCO ETF and 2 iShare ETFs are the bond investments in this scenario. So how does this all really work? Over the last 15.5-year period, this is a chart of when sector ETFs would have been used and when bonds would have been used. The bond ETFs are shown in the light purple sections, and the sector ETFs are shown in the light green sections. Here's a quarterly summary of the same 15.5-year period. 62 quarters have elapsed during this time frame. 43 of the quarters had sector ETF exposure, which is approximately 70% of the time, and 19 of the quarters had bond exposure, approximately 30% of the time. This is a performance chart for the same period of time, 15.5 years. The blue line in the middle is how this model performed over the last 15.5 years. You may also notice that I've added an additional model to this chart. That's the purple line at the top of the chart. This is an aggressive growth model using 4 sector mutual funds that happen to use leverage. That means borrowed money or debt instead of the 4 unleveraged sector ETFs. This is the sector rotation model on steroids. This leveraged model is not for everyone. The S&P 500 is the black solid line on the very bottom of the chart. This chart compares the sector rotation model to the S&P 500 over the last 15.5 years. In this case, a fictitious investment of $500,000 was made on January 1st of 2001. With the sector rotation model, it has grown to a little more than $3 million, with a compound average growth rate of 13.16% and a Riskalyze number of 40. Riskalyze is a risk assessment software tool that we use with our clients, and the scale is from a low of 1 to a high of 99. The S&P 500, on the other hand, had a compound average growth rate of 3.12%, and the $500,000 grew to a little more than $780,000, with a Riskalyze number of 75, almost twice the risk of the sector rotation model. There is one final statistic that I believe is very important. That is the maximum drawdown percentage shown on the lower right-hand corner of the slide. This means that during any downtrending market, the difference between the top of the market and the bottom of the market is the drawdown percentage. Another way to look at this is the percentage of investment funds you would have lost in any one single time period. The sector rotation model, as you can see, had a maximum drawdown of 13.6%, and this occurred at the end of October 2005. The S&P 500, on the other hand, had a maximum drawdown of 56.8%, and this occurred at the end of March 2009. That is a significant difference. You can also see the annual rates of return along with a comparison to the S&P 500 along the bottom of the chart from 2001 through 2015. Please notice 2008. The sector rotation model achieved a positive annual rate of return of 8.4% that year, whereas the S&P 500 was down 38.5%. This second page of the chart shows some additional technical information concerning the investment model, as well as one interesting item that I'd like to mention. Right in the middle of the page, I have added an annual wealth advisory fee of 1.3% to all of the numbers. since that is what we normally charge for a $500,000 investment account. All of the rate of return numbers shown on the previous page are net of this 1.3% wealth advisory fee. So the advisory fee has already been included. This is a chart of the leveraged version of the sector rotation model. The initial $500,000 has grown to more than $4.5 million instead of $3 million, with a compound average growth rate of 16.49%. Once again, this is net of our 1.3% wealth advisory fee. The maximum drawdown also increased from 13.6% to 19.6%. So this model is not for everybody. But this is still a far cry from the 56.8% drawdown that the S&P 500 suffered in 2008 and 2009. Here's the second page of the chart with the additional technical information, including the advisory fee of 1.3% added in. Let's summarize. In bull markets, we use the top 4 performers out of 11 sector-based ETFs. In bear markets, we use the top 3 bond performers. We have a leveraged version available for clients that are a little more aggressive, and rebalancing occurs on the first day of each month. What's the bottom line for this new model? It's a great performer, but it's not for everybody. And even for those that it is appropriate for, it's best used as a piece, not all, of the client's portfolio, since it can become concentrated and therefore very dangerous occasionally. For our aggressive clients, the leveraged sector rotation model is an additional alternative, but once again, for a piece, not all of a client's portfolio. In a later video, I'll review the advantages of blending investment models in order to enhance return and minimize the risk of loss. But for now, I'd like to make sure that everyone understands that each one of our 4 core investment models, conservative, balanced, growth, and growth leveraged, is in fact a blended portfolio of more than one single investment approach. I found that this is the most effective way to enhance returns and lower the risk of loss. Which blended investment approach is most appropriate for you? Well, that's an individualized decision that's usually based on age, health, tax situation, amount of income that you own that is guaranteed, family status, personality, etc. As I mentioned earlier in this presentation, we also have each of our clients complete a specialized risk assessment called Riskalyze, which gives us an actual number to use when assessing which approach is most appropriate. Well, that's it for now. I hope you've enjoyed this brief overview of the sector rotation model. Feel free to browse around our website on the video pages for new and updated content if you're looking for some more information. This is the standard disclaimer page that I need to provide you with. Go ahead and read it quickly if you'd like. It basically says that the information in this presentation is general in nature, and if you'd like to implement any of these concepts, you should seek out a trained professional to craft a specific program for your individual needs. It also says that there are no guarantees in the financial markets, and I think everybody understands that. We'll talk a little bit more about guarantees and where to get those in some of my other presentations. Thanks for watching and listening. I hope this information has been helpful. If you like what you saw, I actually have some more, and I'll be releasing new video presentations periodically and updating the old ones as well. If you'd like to get access to this educational information, make sure you provide me with your name and email address, and I'll definitely add you to a special list I've created so that you can receive notifications about new educational content when it becomes available. You can do this by making your way back to the main home page of our website and completing the Join Our Free Email List box in the upper right-hand corner. Thanks again for watching and listening. I'll talk to you soon.